You know how sometimes you want to invest, you hear all these terms, and it just feels like wading through alphabet soup? Mutual funds, ETFs. Today, we're diving into two of the biggest players, mutual funds and ETFs. Exchange-traded funds? Yeah, there's definitely common confusion there. Our goal today, simplify that choice. Okay, let's unpack this. By the end of this deep dive, hopefully you'll have a much better sense of which one might be right for you. We'll define each one, highlight the key differences, weigh the pros and cons.
And really help you figure out how they fit with your own personal goal.
Exactly. So first up, the classic mutual funds. Think of it like this. A big pool of money collected from many, many investors, lots of people chipping in. Now, instead of you trying to pick individual stocks or bonds, that pooled money, it gets handed over to professional fund managers.
Right. These are the people whose job it is to do the research, the analysis.
Yeah, they actively pick the stocks, bonds, or whatever assets the fund is supposed to hold. You're basically delegating.
You don't pick the assets, the manager does. It takes that burden off you.
And when you invest, you're buying units of the fund. Now, here's a really key point. The price, the net asset value, or NAV, it's only updated once a day.
Yeah, right at the end of the trading session after the market closes.
So that NAV reflects the total value of everything the fund owns, minus liabilities, divided by all the units out there. It's a snapshot at close.
So if you put in an order to buy or sell during the day,
You get that end-of-day price, not the price from, like, 11 a.m. This makes it, well, pretty convenient for beginners, right? People who don't want to track moment-to-moment prices or research individual stocks.
definitely. Think about, say, an equity fund investing in the top 50 companies in the country. The manager handles all those choices. And what's fascinating here, I think, is how that professional management simplifies things. Especially if you're new to the market, it really takes the burden of constant decision-making off your shoulders, which can be, honestly, a big psychological plus.
That's a great point. It lowers the barrier to just getting started and staying invested.
Exactly. Features like systematic investment plans, SIPs, they automate it. It becomes less about timing, more about consistency.
Right. Okay, now let's talk about its close cousin, the ETF, or exchange-traded fund. It's also a pool of money investing in many securities, just like a mutual fund.
A basket of assets.
But here's where it gets really interesting. The trading mechanism.
Yes. The big difference.
ETFs trade like individual stocks on a stock exchange, which means their price moves throughout the day.
Constantly fluctuating based on buying and selling pressure, just like, say, Apple stock or any big company.
You can watch the price change in real time. You can buy or sell pretty much anytime the market's open.
Instant execution, market prices.
And here's another key distinction. Most EPS are passively managed.
Right. Unlike most mutual funds with their active managers.
ETFs usually aren't trying to beat the market. They just aim to track a specific index.
Like the Nifty 50 or the
Yeah.
S&P 500 or the NASDAQ, whatever the benchmark is.
So if the index goes up 1%, the ETF tracking it should go up roughly 1%, minus tiny fees, of course.
Yeah, the goal is replication, not outperformance.
So with an ETF, you're basically buying that whole basket of index stocks in one click.
Yeah.
Instant diversification. And you get that trading flexibility we talked about. Buy at 10 a.m., sell at 2 p.m. if you wanted to.
And if we connect this to the bigger picture, that passive management and continuous trading, it represents a different philosophy, really.
How so?
Well, it's sort of focused on market efficiency. The idea is that it's really hard and expensive for active managers to consistently beat the market average over time, especially after fees.
Okay.
So instead of trying, passive investing just says, let's capture the market's return at a very low cost.
So you're mirroring the market, not trying to outsmart it.
Exactly. It often appeals to investors who believe in the overall market's long-term growth,
Right.
rather than relying on a specific manager's skill. Trusting the wisdom of the crowd, so to speak, but efficiently.
All right, so we've got the basics of both. Mutual funds, usually active, priced once a day. ETFs, usually passive, trade all day like stocks. Now let's really put them side by side, the key differences. This is where you start seeing which might fit you better. First, management style. We've touched on this, but let's nail it down.
Active versus passive, that's the core.
Mutual funds, typically active. Fund managers making decisions.
Researching, buying, selling, trying to find opportunities.
ETFs,
Yeah.
usually passive. Tracking an index, following a set recipe.
So one's got that seasoned chef, like you said, constantly tweaking things.
And the other is following a proven recipe, aiming for consistency with the benchmark.
Right. And that difference leads directly to the next point, fees. or expense ratios.
Ah, yes, the costs. Always important.
With mutual funds, you're paying for that active management, the research team, the trading. So expense ratios tend to be higher.
Makes sense. You're paying for expertise.
Whereas ETFs, being mostly passive, have much less overhead. No big research team needed just to track an index. So the fees are generally much lower.
Significantly lower sometimes.
Oh, absolutely. And this really matters for long-term returns. Lower fees mean more of your money stays invested and compounds over time.
Even a small difference in fees can add up to a huge amount over, say, 20 or 30 years.
It's one of the biggest arguments for passive investing, that cost efficiency.
Okay, next up, liquidity. When can you actually trade these things?
We hinted at this too.
Mutual funds. You buy or sell only at the day-end NAV price. Place your order anytime, but the transaction happens at that closing price.
No intraday trading possible.
ETFs. Trade anytime during market hours, just like a stock. You see a price you like, you can buy or sell right then and there.
Real-time price discovery and execution.
So if you value that ability to react quickly to market news or price moves during the day.
ETFs definitely have the edge for liquidity and flexibility.
All right, what about tax efficiency? This one's maybe less obvious.
Yeah, but it can be really significant, especially in a taxable investment account. ETFs generally win here.
Why is that?
It's partly due to how they're structured, especially the passive index ones. They tend to have lower turnover, less buying and selling of the underlying stocks within the fund compared to an actively managed mutual fund.
Okay, less trading inside the fund.
Means fewer capital gains are realized inside the fund. Plus, there's this mechanism called in-kind creation and redemption for ETFs. It lets them swap stocks for ETF shares without actually selling the stocks for cash, which often avoids triggering taxable capital gains that would have to be distributed to shareholders.
Ah, clever. So the ETF itself, it generates fewer taxable events.
Generally, yes. Active mutual funds, because the manager is buying and selling more frequently, can generate more capital gains, and those gains often have to be distributed to you, the investor, each year.
Even if you didn't sell your own mutual fund units.
Exactly. You can get hit with a tax bill just for holding the fund if the manager was actively trading. ETFs tend to minimize that.
That's a really important point. How much of your return you actually keep after taxes.
Definitely something to consider for long-term wealth building.
Okay, last big difference. Ease of use. How easy is it to actually invest?
This is where mutual funds often shine, especially for beginners.
Right. Setting up those systematic investment plans, SIPs, super simple usually.
You link your bank account, set a monthly amount, and it just happens automatically, very hands-off.
Kind of the set it and forget it approach.
Yeah.
Builds discipline.
Totally. ETFs, on the other hand, require a bit more active involvement.
You need a brokerage account or a trading account.
And you have to actually place the buy and sell orders yourself, like buying a stock. You need to know order types, maybe watch the price a bit.
So maybe a slightly steeper learning curve for someone brand new to investing.
Potentially, yes, although brokers are making it easier all the time. But it's not quite as automated as a traditional mutual fund SIP often is.
So one's like automating your savings, the other needs a bit more hands-on trading know-how.
That's a good way to put it.
Okay, so we've laid out these differences. Active versus passive, fees, trading, taxes, ease of use. Let's talk pros and cons directly. Weighing the options. For mutual funds, pros. Definitely that professional management. Good for beginners. SIPs make regular investing super easy.
Takes the decision-making burden off you, automates discipline.
Cons. Higher fees typically, less control over what's actually in the fund day to day, and only priced once per day. No intraday moves.
The trade-off for convenience is often cost and flexibility.
Now, ETFs. Pros. Low cost is huge. Highly liquid, trade them all day. Generally more tax efficient. Transparent, you usually know exactly what holdings are in an index ETF.
Cost, flexibility, transparency, tax efficiency. Strong point.
Cons. You need that brokerage account. Might be slightly harder for absolute beginners who aren't comfortable placing trades.
And traditional fully automated SIPs might not be quite as straightforward everywhere, though options are improving fast. Requires a bit more self-direction. Understanding these trade-offs is so crucial. It's not just about features on a list. It's about how those features align with your personality, your comfort level with investing, how hands-on you want to be.
Yeah, your investment style.
Exactly. Someone might happily pay a bit more in fees for a mutual fund because they value the peace of mind of professional management and the ease of SIPs.
While someone else might be really focused on minimizing costs and maximizing tax efficiency, and they're comfortable managing a brokerage account for ETFs.
It's personal. What trade-offs are you willing to make?
So this brings us to the big question. Which one is better for you? And the answer, maybe unsurprisingly, is it depends.
Always the answer in finance, isn't it? It depends.
It really does depend on your preferences, your goals, your comfort level. But we can offer some guidance. Let's try to make it clear. Mutual funds are probably a better fit if you are a beginner. Really value simplicity and convenience.
If you want that expert oversight and don't want to get into the weeds of trading.
Exactly. And if you love the idea of automatic regular investing through SIPs, set it and forget it.
Hands-off approach.
On the other hand, ETFs might be the smarter choice if you really prioritize low fees. That's a big one for you.
If you want maximum transparency and flexibility.
If you're comfortable using a brokerage account, placing your own buy and sell orders.
And you value that ability to trade intraday, reacting to market prices in real time.
Lower cost, more control, more flexibility, maybe leaning towards ETFs. Simplicity, automation, expert management, maybe leaning towards mutual funds.
Ultimately, yeah, it's about matching the vehicle to your own investing temperament and practical needs, your personality almost. Are you someone who likes to be hands-on, or do you prefer to delegate? Are you super cost-sensitive, or do you value convenience more?
There's no single best, only what's best for you.
That's the key takeaway. Self-awareness is critical here.
So wrapping this up, here's the truth. Both mutual funds and ETFs are really excellent investment tools. Seriously.
Absolutely. Both offer diversification, access to markets, powerful ways to build wealth.
One isn't inherently better across the board. The best choice, the one that fits your life, your goals, how comfortable you are with the process. And hey, here's a thought. You don't actually have to choose just one.
That's a really important point. It's not necessarily an either situation.
Right. Many savvy investors use a mix. Maybe they use mutual fund SIPs for their core long-term automated investing, building that foundation.
Leveraging that simplicity and discipline.
And then maybe they add some low-cost ETFs for specific goals, like getting broad exposure to the S&P 500 super cheaply, or maybe targeting a specific sector or international market.
Using each tool for its strengths, combining the automation of mutual fund SIPs with the low cost and flexibility of ETFs.
Exactly. Building a portfolio that uses the best of both worlds. So maybe the final thought is, don't get paralyzed trying to find the absolute perfect option right away.
Yeah, analysis paralysis is real. Understand the differences, see which aligns better with you now, and then just start. Start small, be consistent. Let that compounding work its magic. Often, the most important step is just getting in the game.
Well said. And remember, keep learning. As your financial situation evolves, as you learn more, maybe your preferences will change too. Continuing to understand how these tools work and how they fit into your bigger financial picture, that ongoing learning is probably the most valuable investment you can make in the long run.